I'm sure you've seen the headlines, people making insane money in crypto, becoming millionaires in just a few months, and traders making thousands of dollars in minutes. These big wins are stories that seem too good to be true, but they're happening right in front of your eyes. But then in reality, it's a little different. You might have jumped in, maybe bought the dip, chased some random hype on an X post, only to watch your portfolio drop day after day, wondering what went wrong and why it's not working out like you expected. Crypto's a roller coaster, and as a beginner, it's easy to get caught up in the excitement without realizing the true risks. And trust me, you're not alone on this. This happens to so many new and existing investors. Here's the thing. No one talks about the mistakes that could completely wipe out your entire crypto portfolio in a matter of days. And no, it's not some sudden black swan event, liquidation crisis, or bad timing. It's something much more subtle, something that almost trips up every beginner. If you're just getting into crypto, or if you've watched your portfolio shrink over the last few weeks, you might already be falling into this trap. But don't worry, my goal here is to show you exactly how to avoid these costly mistakes and protect your investments moving forward. By the end of this video, you'll know what to watch out for, how to improve your mindset and strategy, and most importantly, how to avoid the top 5 mistakes most beginners make to keep your portfolio on the right path. So let's talk about the first and one of the most common mistakes beginners make: FOMO, or the fear of missing out. Crypto moves fast, and it's easy to get caught up in the hype. You'll see coins pumping 50, 100, or even 1,000% in a few days, and you're seeing it all over your feed on social media. This is when many people start thinking it's the perfect time to buy and ride the wave. But the problem with that is, by the time you're hearing about it, it's usually too late. Just 1 month ago, we witnessed a prime example of FOMO when Argentina launched its own coin called the Libra, which claimed it would support small businesses and entrepreneurs. As soon as this was tweeted on X, the hype exploded and so many people rushed in to buy. But this wasn't the first time we've seen something like this play out, because just 1 day before the inauguration of Donald Trump, he launched his own meme coin called Trump. It instantly went viral across social media, and in just 24 hours, it skyrocketed by more than 12,000%. Now, to put that into perspective, that means if you bought $100 worth of Trump when it first launched, that $100 would be worth over $12,000 in just 24 hours. This was something the crypto space has never seen before, and the level of hype surrounding it was way beyond anything I've ever witnessed since I started my journey in crypto. Not even Dogecoin at its peak came close. The way it took off and grew so big in the matter of minutes made it arguably the biggest moment in meme coin history. And these same FOMO investors panic bought into Libra as they expected the price to soar like Trump coin did and make them rich. In the matter of a couple hours, the project rug pulled and the coin crashed over 90%. Now I get it. You're seeing the hype, watching others make quick and easy gains, and it feels like an opportunity you can't miss. But by the time most of these people jump in, the early buyers are already selling, and sometimes you're even going to end up getting rugged. This is exactly how these hype-driven pumps work, which triggers your FOMO to an all-time high. And this is what leads to the biggest mistake, which is buying impulsively. Instead of making a calculated decision, people rush in without a plan purely based on emotions. But in crypto, acting on emotion is the fastest way to lose money. Now, to avoid falling into this FOMO trap, here are 3 simple strategies you can start using right now. The first one, have a plan before you buy. Before you put any money into any crypto, ask yourself why you're buying, what your goal is, and if you're investing for the long term or just chasing a quick pump. If you don't have a plan, you're not investing, you're gambling. Next, stop letting social media dictate your trades. Now, X posts, Telegram groups, and TikTok thrive on hype. When everyone is talking about a coin, it usually means the smart money already got in and they're now looking for buyers to sell to. When it comes to crypto, social media is not designed to make you money. It's designed to drive engagement, and oftentimes influencers and news outlets are already pushing out what's already moving, not what's about to take off. If you're simply just making trades purely based on what's popular online, you're not investing, but you're the exit liquidity for the people who got in. And number 3, buy with purpose, not emotion. Retail investors often make decisions based on emotion, jumping in when prices are rising and chasing excitement. But the smart money think strategically, not impulsively. When you see a coin surging, don't think that you'll need to buy it right now before it's too late. Instead, ask yourself, who's selling to me right now and why? The people winning in crypto aren't the ones scrambling to buy in after the hype. They're the ones repositioning themselves before the crowd rushes in and exiting before the hype fades. So focus on buying assets with long-term value, not just the latest trend. When you start thinking like smart money, you won't be the one left holding the bag. Now, FOMO is dangerous, but what's even worse is jumping into an investment without really knowing what you're buying. This is where the second biggest mistake comes in: ignoring research. A lot of the time, that rush to buy comes from the fear of missing out, but the reality is that blindly following the crowd without truly understanding what you're buying can be the difference between success and a massive loss. Many beginners skip over this crucial step as they're in a rush to make quick gains. Take Libra again, for example. When Argentina launched its own coin, everyone was talking about it, but how many people actually took the time to understand who was behind the project and understanding what the long-term goal was, finding out if the team was reputable, and if the coin even solved a real-world problem? I can tell you very few looked at those questions before buying and ended up losing a lot of money because they skipped the research. What you need to understand is that crypto is extremely volatile, and while following trends might seem like an easy way to make a quick profit, it's not sustainable if you don't understand the project's real value. Without researching, you're essentially betting on something you don't understand. When you skip the research, you're gambling on hype and hope, because all that's running through your mind is a 6-figure portfolio or some random imaginary numbers if you just hold. That makes you a lot more vulnerable to pump and dumps and investments that won't live up to their promises. So in order to avoid this mistake, it's all about understanding what you're investing in and looking deeper than just a trading call out. And the best place to start is by reading the white paper. A white paper is essentially the blueprint for a crypto project. It tells you what the project is, how it works, the goals, and tokenomics. If you're not reading the white paper before investing, you're effectively blindly trusting others to make the decision for you. Secondly, dig into the team behind the project. What you want to do here is actually look into the team that's behind this coin. The team is the backbone of a project, so it's important to research who's running the project and taking a look if they have any experience in the blockchain space, or are they simply just marketing experts leading to a pump and dump. A team with solid experience and a proven track record is far more likely to deliver a solid project than a team of unknowns with nothing but a flashy website to show. Third, look at the real world use. You're going to want to ask yourself what the project is trying to achieve. Does it solve a real world problem, or is it just creating hype just because everything else is booming? You'll see a ton of times during euphoric stages of a bull market where people are creating coins left and right just because everything else is booming. So if the project doesn't have a clear value proposition, you're better off skipping it. Going into the third biggest mistake you can make is investing more than you can afford to lose. Now, it's easy to get caught up in the excitement of a new investment, especially when you see other people making massive gains. But it's important to understand that investing more than you can afford to lose is not only the quickest ways to wreck your portfolio. You could also go into debt and have troubles repaying your rent, car payments, or even mortgage. And I've made this mistake myself. As someone who's been involved in crypto for about 4 years now, I've had to learn the hard way. Look, I'm gonna be honest. When I first started, I wasn't making much money at all. But whenever I did have money, either from a profitable trade or working at my aunt and uncle's pizzeria, I never properly budgeted, and about 6 months into my journey, I did something I would regret for a long time. I ended up throwing everything I had into one coin because I saw this vision of me making tens of thousands of dollars within weeks. I almost started to feel like I already made the gains. I even went as far as trying to find ways to borrow more money to put into this project and double down and really go all in. Luckily, I wasn't even of age at that time, so I couldn't physically take out any loans, and that's a decision I'm thankful for now because I ended up getting rug pulled. The coin that I put all my money into vanished. It was gone from my wallet and I was left with $0. It hit me almost instantly and I couldn't help but question what the hell happened. The regrets started flowing and I remember even thinking about quitting crypto at one point. I thought maybe this just wasn't for me. Looking back, I realized failure was one of the most important lessons I've ever learned because investing isn't just about making money. It's about managing risks, controlling emotions, and just knowing when to step back. Over time, I realized that couldn't just be the end for me. I could have walked away and never traded crypto again, but I chose to learn from it, and now I have a set of rules that help me stay out of this path. The first is knowing your budget. Before you invest into anything, know how much you're willing to risk, take a look at your finances, and set clear limits on the amount you can comfortably invest in crypto. This way, you can budget your income so you're not dipping into funds you need for essentials or an emergency. If you start setting these boundaries from the start, you'll have a solid plan in place, helping you avoid unnecessary losses. The second is setting realistic expectations. Success in crypto isn't about chasing quick gains, it's a game of patience and consistency. Setting realistic expectations means realizing that not every investment will be a winner. Prices will go up and they will come back down, and that's just simply how the market works. You will take losses, and this is something you just mentally have to prepare for because then you're more likely to stay disciplined and less likely to make emotional decisions that could take a good chunk of your crypto portfolio. Now, the fourth reason why beginners lose money in crypto is not understanding how volatile the market is. Most people think they can handle the swings until they actually experience them. At first, you'll feel like you have everything under control, but when the drop or correction comes, it'll be bigger than you expected, and it's not about seeing your portfolio balance drop, it's the panic that kicks in when you have no idea what's coming next. To be honest, this is where a lot of beginners get caught up, and it's not always about the numbers. It's also about how it makes you feel. You'll see prices rising and your excitement starts to feel like you're on top of the world, and you start thinking about what you're going to be doing next with your gains. It's almost like you can picture a brand new car or a trip to Dubai. But then out of nowhere, the price starts to fall fast. And when it goes down and you're not in profit anymore, you start telling yourself, all right, I'll sell when I break even. The problem is this mindset does not work. The dip could keep going, and now you're in a situation where you've got to make a decision. To hold on to whatever is left, or do you sell and lock in those losses? And that's the trap. All beginners get emotionally attached to the fake gains or breaking even when you're down. When you do this, you're not making decisions based on strategy, but by being desperate and emotional. The reality is, crypto is volatile and will remain that way for some time. And in this case, the best decision is to step back, control those emotions, and make decisions with a clear head. Here's how you can do that. Number one, accept that volatility is normal. Crypto is unpredictable and the wild price swings are just part of the game. It's part of every market cycle, and instead of screenshotting your portfolio when it hits new all-time highs or getting emotional when prices drop, remind yourself that pullbacks happen all the time. These corrections are needed and it's healthy for the market. So I tell people all the time to zoom out and focus on the bigger picture rather than reacting to every single little move in the market. Secondly, stop checking prices 24/7. One of the worst things you can do is stare at your portfolio all day. Watching every single price movement will increase stress and make you more likely to make emotional decisions. Instead, set some price alerts or check in at certain times so you're not constantly glued to the charts. I know this is hard because you have a ton of emotion inside of you, But one thing we always tell our members in Kaizen is that if their portfolios are down bad, is to take breaks. Step away from your computer, go for a run, or do anything that won't get you checking your phone. This allows for you to clear your head and avoid making moves based on short-term fluctuations. Now, the last mistake that beginners make is not having an exit strategy. The real key to success is knowing when and how to exit your investments. This is where most beginners fail because without an exit strategy, you're just hoping things go your way, but hope is not a strategy. You can't rely on luck to guide your investments. You need a clear plan so when things go up or down, you already know how to react. Keep in mind that everyone's situation is different. What works for one investor might not work for another. And that's why it's crucial to tailor your exit strategy to fit your personal goals, risk tolerance, and investment style. Once you're clear about your position, you can create a plan to your needs. And this isn't just a theory. I've been there too. I know what it's like to watch my portfolio skyrocket and feel like I'm a master at investing and then see it all come crashing down because I didn't know when to sell. I've made this mistake numerous times, letting emotions take over, and I've lost tens of thousands of dollars because of it. This mistake is 100% avoidable, and that's why I'm sharing this with you so you don't have to lose thousands of dollars and learn the hard way like I did. Now, to protect your gains and avoid losing out on money, you need to start with these 3 key things. Number 1, set profit targets. Before you even enter a trade, you should decide and think about what price you'll start taking profits. It doesn't have to be all at once. You can take profits in partial positions along the way because if the market ends up reversing, you'll have already locked in some gains instead of watching all of that disappear. Secondly, use stop losses. A stop loss is like a safety net when bungee jumping. When you jump off the platform, you're trusting the bungee cord to slow your fall, but in some cases, the cord could snap and the safety net below will catch you, preventing a tragedy. In this case, setting a stop loss automatically sells your investment when the price drops to a certain point, which protects you from losing a lot more. Number 3, have an exit plan for different scenarios. Now, just because you're trading in a bull market doesn't mean you should expect big gains. You should plan for different scenarios. Markets don't move in a straight line, and they surely don't repeat themselves. They will rhyme, but no one can predict exactly where prices will go. Think about what you'll do if your investment doubles, drops 20%, or trades sideways for months. Having a plan for these outcomes makes sure you're prepared. And that's why exactly we here at Kaizen have built a community focused on helping beginners just like you succeed in crypto. These markets are tricky, and I get it. It's so easy to get swept up in the hype and volatility, but with the right strategy and mindset, you can take your portfolio from here to here. It's about understanding market cycles, making informed decisions, and having a plan for every scenario. These 5 mistakes covered today are among the most common ones we see across our community, and that's why we have a full team of analysts and a 40+ person team to support every single member to make sure they can succeed in crypto. It's a space where beginners can connect and learn with like-minded people who are on the same boat. We're here to help you avoid common mistakes and take your goals to the next level. So if you're ready to take your portfolio to the next level and get expert guidance every step of the way, check out the link in the description down below and join the Kaizen community. As always, make sure you drop a like on this video and subscribe to the channel. Turn on your post notifications so you don't miss out on more videos like this. I'll see you guys in the next one.